Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Marcus New, founder and CEO of InvestX, which provides the $30 trillion wealth management industry with the ability to access, invest, and trade in late-stage private companies. Marcus, it's great to have you with us. Welcome to Trade Talks.
Thanks so much, Jill. Great to be here.
You got it. And can you share a little bit about your background and what led you to founding InvestX?
Yeah, well, I've been involved in covering the public equity markets for almost 20 years. And one of the things when you're deeply in that, as you probably know, because you cover it as well, you see these changes happening in the private markets. And so back in 2014, we saw that a lot of these companies were staying private longer, which is a big trend today. Everyone's been talking about it for 5 years, but back in 2014, there wasn't a lot of that. And so when we saw that, we looked at it, we said, geez, there's about 10 institutional investors that are making all the money. They're the same Fidelity and T. Rowe, and they're the ones investing, keeping these companies private longer, and they're taking all the returns. We said there's got to be a way to get in there and actually help other people get access to those markets outside of those 10 club investors. I call them club investors because they're the same kind of 10 people each time. And so we started the business with the idea to be able to help get more access to family offices and high net worth clients and other types of institutional customers, the ability to get access to this asset class in a much more effective way. It's been an amazing ride since, as you can imagine.
What can you tell me about InvestX and how it fits into the financial ecosystem?
Yeah, so we provide, again, high net worth clients, but through the broker dealers, wealth managers, the ability to get access to this asset class. So to be able to put some of their portfolio into these late stage pre-IPO asset class. We also help institutional investors be able to block trade or be able to trade larger blocks of stocks as well. Because as you probably know, over the last at least 5 or 6 years, there's been a kind of a burgeoning secondary market for institutions that want to be able to invest in these companies before they go public as well, right? And so we do both things. We help to actually facilitate block trades for institutional investors, and then we help more kind of retail investors, although they're high net worth, but retail investors and family offices, et cetera, to be able to add to their portfolio. So we have an investment team that looks at companies, we select companies, we go through the analysis, we have multiple funds, and there's a few big things, right? So to give you context, the private markets are super inefficient, right? If we think about the public markets, everything trades basically a penny between the bid and offer, high liquidity. Information, though, is available everywhere, right? And so, it's difficult to beat the Goldman Sachs computers, is what I like to say, in the private or in the public markets. In the private markets, the exact opposite. You have multi-billion-dollar companies that trade basically like OTC stocks, right? The ability to get information is really, really difficult. The ability to actually get price discovery, understand pricing, bid offer spreads in the private markets today. You could run convoys of trucks through them. They fit so far apart. Right. And so one of the interesting things that has happened for issuers, though, in the private markets is they're really trying to right now manage the next capital fundraising. You don't see any of that happening in the public markets, of course, but in the private markets, they're trying to manage it, because if they don't manage it, what happens is that they're going to potentially get crushed because the valuations have dropped so much in the public markets. And so there's kind of this delay factor happening in the private markets where companies cut quicker than the public markets. You've heard a lot of the announcements of private companies cutting faster. Part of the motivation for cutting faster is to try to avoid the crush, what's going to happen if they have to raise right now in this market, right? And so if they can extend out the balance sheet and get through kind of the bear market that's happening in the public markets, they can potentially avoid that. So I'd say that's one of the big things. One of the other big trends is the crossover investors have really left the private markets temporarily. And I don't know how long this will extend to, but if you look at Coatue, you look at Tiger, and you look at these types of companies, they kind of stopped investing now in the private markets for a delayed period of time. This lack of capital now is creating stronger bids and offer spreads, right? And so we actually think it's a really, really interesting time where a lot of money will get made, because we saw this happen in COVID as well, where the market basically in the private market just went no bid. They literally went no bid, right? And I remember we put a bid on Airbnb, for example. It was like $43 a share in the private markets where there's no bid at all. And we got hit by an institutional investor who just needed to sell and get liquidity. And all of a sudden it became a huge successful investment for us. But those are some of the things you can only do in the private markets. We are putting bids on stocks that are incredible quality, multi-billion-dollar companies. But because the market's so inefficient, someone sometimes needs to have liquidity. So there's some interesting opportunities happening there. Most of the valuations, though, or like the new rounds are being done really with either preferred terms for investors, probably for the first time in 3 years, to be honest. Or they're down rounds, but preferred terms for investors where there's different types of picks or guaranteed returns almost. And there's always exceptions, right? Like SpaceX did an up round in this market, right? Again, a world-class company, an incredible company. But there are some few exceptions, but I would say they're much more fewer. So.
Yeah, well, let's talk about that a little bit more. In light of a looming recession, do you think private equity will outperform the public markets?
Well, private equity, and where we are really is in growth equity versus maybe true private equity, where you're basically taking control positions using leverage, et cetera. And when leverage is up higher now as it is, obviously the purchase prices have to be lower now, right? Because you can only get 3 or 4 times, cash flow to be able to take in leverage. So, but in the growth markets, for example, in the private markets, that's where growth is, right? And so if you think about that, IPOs pay for growth. When companies go IPO, they grow, right? And so you look at the growth rates in companies when initially IPOing, they're all really, really high. The public companies have had a very difficult time sustaining that, right? And so, even you look at a world-class company like Salesforce, I mean, it was really running 20% a year growth rate, right? And a lot of that was through acquisition, right? And so, but you see the growth rates are in the privates. So we think the privates outperform it as they typically do because that's where growth is. Now, if you're a growth manager today in the private markets, you basically have what I call a dead year. What I mean by that is that, you might have bought something at 16 times, ARR today in a SaaS business, but the public markets are trading at 9, right? And so there is still some premium being paid in the private markets. And so sometimes your company's going to have to grow into that, right? So, but it's got a faster growth rate. So if it has a 40% growth rate, for example, it may take an extra year to grow into 9, versus where you bought it at 16. And so I think all the returns in general come down in previous vintages because there'll be this dead year slapped into the return on the overall fund. But in general, new vintages now, like for example, we're launching Fund 4, we think it's gonna be an incredible time because we're buying this side of the cycle, in these kind of markets where you can put in low bids.
Right, I mean, it could be a gift potentially, right? So Marcus, to wrap up here in the last minute, what's next for InvestX?
Yeah, a big thing for us right now is we've got Fund 4 coming out, which is really exciting for us. We think it's an incredible vintage. We'll use the same strategies we used in COVID, which is basically to put in some incredible quality companies, but put in some of these low kind of stink bids, if you want to think of it that way, right? Because someone always needs liquidity in markets that are really inefficient. The other piece too is continue to work on helping our institutional investors to be able to get access to trades too. A number of them want to trade $50 million, $100 million of some of these companies, and they lack the ability to actually find the other side of the trade. And so our kind of block trading board helps to facilitate that too. So